Okay, guys, let's continue our class. So we have started the second part, which is about stock trading basics. And we talk about many two types of prices, the bid price and the ask price. And then we talk about two types of orders, the market order and limit order. So today we're going to talking about margin and short sell. First, we will talk about buying on margin. And then, based on what we have learned about buying on margin, we could proceed to talk about short sell. So, first, what is buying on margin, right? So, here, buying on margin basically means that you're purchasing a stock. However, you're borrowing money to make your purchase. So it means you're borrowing part of the total purchase price of a position using a loan from your broker, right? So here, margin is basically the percentage contributed by the investor. And very quickly, you will see how do you exactly calculate margin. So now we're just dealing with this basic definition here. There are two types of margins to talk about. The first is initial margin, which is, basically the initial margin, right? It means when you initially make your purchase, what is the margin requirement? Generally, the percentage requirement is 50%. What does this mean? It means if this stock is worth $100, then you have to at least contribute $50. Or you could say if the stock's price is $100 and if you want to buy one share, at most you could borrow $50. And then there is this maintenance margin after the initial margin. Basically, judging from the name, you could see that maintenance margin refers to the margin level you have to maintain in your position, right? Generally, it is at 30%. It basically means that at any time, if the value of your position is like, let's say $100, then at least your own money has to have a percentage of 30%, right? 30% is not universal. Basically, this maintenance margin can change between different types of brokers. For example, if you're at a low cost broker, right? Potentially, this broker could give you a or set a 40% maintenance margin. Or if you're at a different broker, this broker could set a 50% maintenance margin. And this maintenance margin also changes by types of assets. Generally, if your asset is riskier, then the maintenance margin will be higher. If you actually trade, then you can see that for some types of ETFs with leverage, the brokers will generally set a higher maintenance margin. Of course, this maintenance margin is generally higher than 30%. So it's very important for you to understand what is the exact requirements on margin from your own broker. Okay, next, you might want to ask what happens if the percentage margin in my account falls below the maintenance level. Well, if this happens, you will be in trouble. So basically, your broker will give you a margin call. And after receiving your margin call, you have to do something to satisfy the maintenance margin, right? And then you can see that here you basically have several choices. The first choice is, which is obvious, you could add more cash. You could add more money into your trading account. And the second choice is you could add more securities. Well, because here, securities could serve as collaterals. So by adding securities, then you could restore your maintenance margin. And then if you don't, right, if you don't add cash, and if you don't want to add new securities, then the broker will have the right to liquidate your position. So basically what will happen is the broker will actually sell some of your securities. By selling your securities, the broker can get some cash. So the broker can use the cash from selling securities to pay your loan and then to make your account satisfy the percentage margin, right? So this is actually pretty important because if you're borrowing money from your broker to make a purchase, you really wanted to monitor your account to avoid a margin call because a margin call generally means you have to either find additional cash or you have to liquidate your portfolio. So it's really important to risk control your portfolio if you're buying on margin. Now let's do this example together, and hopefully this example will give you a clear idea how initial margin and maintenance margin works, and also importantly, how could you actually calculate the margin, right? So let's see the example here. It says you wanted to buy 100 shares of Facebook and $100. The initial margin requirement is 60%, and the maintenance margin is 30%. The first question is, if you want to buy on margin, how much money you need to have at least, right? So let's see how could we solve this. The problem says 100 shares. Share price is 100, which means the total value of your portfolio is 10,000. And then the initial margin requirement is 60%. So you have to satisfy this initial margin requirement, right? So this basically means if you need to buy $10,000 of stock, then this 60% initial margin requirement means you need to at least have $6,000. That is $6,000 of your portfolio have to come from your own pocket, right? You cannot borrow money. I mean, you can at most borrow $4,000. Okay, let's see. Let's see the second. Let's see the second. Oh, by the way, from this problem, right? From this one, you can see that initial margin is equal to 6,000 divided by $10,000, which is 60%. One way to think about the margin is the balance sheet, right? If you have learned corporate finance one, then you should be familiar with balance sheet. So here, okay, I have to, okay, I have to first remove this. Oops, I am getting a lot of price alerts. This is bad. Okay, so let's look at what kind of balance sheet we can get here. So whenever you're thinking about balance sheet, right, you have the left-hand side, which is the asset, and here you have liability, and here you have And here you have equity, right? Or shareholders' equity. So let's see what kind of asset, liability, and equity you have if you're making the purchase and buying 100 shares of Facebook on margin, right? So the asset, what is the value of your asset? Well, it's just $10,000, right? Because you have 100 shares of Facebook and $100. Next, let's see your liability. Well, if you just want to satisfy this maintenance margin, it means you will borrow $4,000 from your broker. So your liability is $4,000. And what is your equity? Well, obviously, it is 6,000, which is also $10,000 minus 4,000, right? Okay, now let's see the second question. If the stock price falls to $70 per share, will the investor get a margin call? This is actually important, right? Just think about it. When you're actually buying a margin, you really want to know when you will get a margin call, or at a certain price, whether you will get a margin call or not, right? So in this time, the stock price falls from $100 to 70, right? So now let's stick to the balance sheet approach, right? Let's see um, how this investor's balance sheet will look like if the stock price decreases to $70 per share. So again, we have asset here. What is the asset? Well, the asset is actually, the asset is actually $70, right? Times 100, because you still have 100 shares. So the asset here is 7,000. Now we also have, okay, I'll call the left hand side as A, which represents asset. What is your liability? It's still $4,000, right? That is your loan, right? You have borrowed $4,000 from your broker to purchase the Facebook stock. Now, what is equity? Well, if you look at this, it's obvious that equity equals asset minus liability. So this tells you it's $3,000. So in this case, let's calculate what is your percentage margin, right? So here margin equals $3,000 divided by the value of your stock. So it's 7,000, right? Okay, let me see what's the answer here. So it's 43%. It's 43%. What is the maintenance margin? It's 30%, right? So basically, this is the number you have to maintain in your account. And now 33% is actually higher than 30%. So you're safe. You will not get a margin call, right? So you won't get a margin call. Right? Okay, next, let's see question 3. How far can the stock price fall before a margin call? Okay, again, let's stick to the balance sheet approach because it really gives you the very clear idea how to calculate margin, right? Now, okay, let's assume, right? Let's assume margin call at price P, right? So if stock price is P, then your asset is 100P because again, you still have 100 shares. What is your liability? Well, it's still 4,000, right? What is your equity? It's 100p minus 4,000, right? So we're basically looking at or trying to find at what price you will get a margin call. So this implies if P is the price at which you will get your margin call, then the percentage margin should be equivalent to your, should be equal to 30%, right? Do you know how to solve this? What you're gonna do is, you can see that this 100p is at the bottom, right? So you want to move this 100p from the left to the right. So what will happen is 100p minus 4,000 equals 30% times 100p, which is 30p. Right? So here you will combine these two terms, 100p and 30p. Basically, you will move 30p from the right to the left. The basic mathematical principle is when you move one value from right to the left, or from right or from the left to the right, you will have to change the sign, right? So it will become 100p minus 30p equals 4,000, which is 70p equals 4,000, which is p equals 4,000 divided by 70. So let me see what's the value here. So it's 57.14. Right, it's 57.14. Okay, now let's see question 4. If the stock price falls to 50, how much cash you need to add to satisfy maintenance margin? If you don't have cash, right, how many shares of Facebook you will have to sell to satisfy maintenance margin? First, you can see that if the stock price is 50, right, 50 is smaller compared with 57.14. So you can see that now you will get a margin call, right? And we have talked about this. If you have a margin call, you need to either add cash or security, or you need to sell some of your Facebook stock, right? So let's see how much cash you need to add if you want to satisfy the maintenance margin. Okay, now let's assume, right? Let's assume you need to add, let's say, C dollars of cash. Okay, so you need to add C dollars of cash. Now let's think about your asset and your liability and your equity, right? So this is your asset, this is your liability, and this is your equity. So basically, your stock price falls to 50. So your asset is 100 times 50. Let me see, which is what? 5,000, right? Yeah, it is 5,000. And additionally, you have cash C here, right? So your asset is actually 5,000 plus C, right? So this is your total asset. And what is your liability? Well, your liability is just your debt, obviously. So in this case, it's still $4,000. Now your equity becomes 5,000 plus cash minus 4,000, which is 1,000 plus C here. And now you have to satisfy the maintenance margin, which means equity divided by stock value has to be equal to 30%. So C equals to 500, right? So you need to add $500 into your account to satisfy maintenance margin. By the way, you can see that when you're calculating margin, the percentage margin is always the equity in your account divided by the value of your stock, right? It's always like this. You can see that this is basically equity, right? This is basically the value of your stock, right? Okay, let me double check whether I am correct. Okay, so you can see that it's $500. Okay, great. Now let's look at the next question. The next question says, let's say you're very unlucky, that is, you don't have enough money. So the only choice now you have is to sell your Facebook stock to satisfy the maintenance margin. Now the question is, how many shares of your Facebook you want to sell to satisfy the maintenance margin? So let's say, assume, right? Assume you need to sell X shares of your Facebook stock. Now let's see what is your asset here. So your asset here is, well, originally you have 100 shares, and after selling X, right? So now you have 50. So this is basically your asset. Now think about liability. Well, you have $4,000 of liability. However, now because you have sold X shares of Facebook stock at $50, so you will actually use this proceed to reduce your liability, right? So what will happen here is you will your liability will become 4,000 minus 40x. Right? Now it's easy to get your account equity, which is asset minus liability. I actually don't know what's the answer here. Okay, I think it's 1,000. So now you wanted your account to restore this maintenance margin. So 1,000, which is your equity, divided by the value of your stock, which is 100 minus X, 50, equals 30%. So, okay, let's see how to solve this. So I will remove 40 and this will become 20. And 20 equals, so you will use the 30% times 100 minus X. This gives you 30 minus 0.3x. I guess x equals to 10 divided by 0.3, which is 33.33. So, well, let's assume you cannot sell these weird fractional shares, right? You have to sell integer shares. So the answer is you will need to at least sell 34 shares. Okay. Next, let's talk about short sale. So short sale is actually more complicated compared with buying on margin. However, we have learned how to calculate margin, right? So this will actually make learning about short sales easier. Well, because short sales, in this section of short sales, we will also need to deal with margin. And it's actually a little bit more complicated compared with um, buying on margin. So first, why do you do short sale, right? Well, because you're expecting a decline in the stock price, right? You want to profit from a decline in the stock price. That's why you want to do a short sale. Now, how short sale works? First, you will borrow, right? You will borrow stock. Obviously, the borrowed stock will become your liability, right? So first, you will borrow stock from your broker. Next, you will sell this borrowed stock, right? And by selling this borrowed stock, you will get some cash, will get some proceeds. So you could deposit these proceeds from selling this borrowed stock into your account. However, you cannot invest these proceeds, right? And at the same time, you need to have cash or securities in your account to satisfy margin requirement. Then, at the end of the day, if you wanted to close out your position, you will buy back the stock and return the stock to your broker, right? So basically, you can see that there are two major steps here, right? Borrow and sell, and buy and return, right? I guess that gives you the gist of this process of doing a short sale. Next, we could also think about the cash flows of a short sale versus a purchase of a stock. So obviously, in this case, you're taking a long position, right? And in this case, you're taking a short position. So when you're taking opposite positions, you will see that you will actually observe opposite cash flows. So let's start from taking a long position. So basically, we're talking about purchase of a certain stock. So let's say we have two dates, right? Day 0 and day 1. At, at day 0, you will buy share at its initial price. And on day 1, you will sell share and you will receive your dividend. So at the end of day 1, you will get the ending price of the stock and you will also get your dividend. And here you can see that your profit is basically the selling price plus dividend minus the initial price. Next, let's think about short position, right? Again, you have two dates, day 0 and day 1. And we have talked about this. If you're doing a short sale, you will actually want to borrow a share and sell it, right? So on day 0, you will get this initial price. However, you can see that if you compare purchase of a stock versus short sale of a stock, you can see that you have this cash outflow on day 0 if you're purchasing a stock, but you will have a cash inflow if you're doing a short sale of your a certain stock. Right? Next, on day 1, you will want to return this share, right? So you will basically buy back the share. And on day 1, you will have to repay the dividend in the process. And you will also want to pay this ending price because you need to buy back the stock. So now you will get a negative sign here compared with when you're buying a when compared with when you're making a purchase of a certain stock, right? So basically you can see that if you're doing a short sale, the profit becomes the initial price minus ending price plus dividend. And if you look at these two formulas, right, you can see the rationale of these two kinds of transactions. If you're taking a long position, right, why do you want to take a long position? Because you want profit. And how do you get a profit? You want this ending price and dividend to be larger than initial price, right? So in a gist, it basically says if you're expecting the stock price to increase, then you will take a long position. And now if you look at the other case, right? If you look at the short sale case, if you want a profit, you need this to happen. That is, initial price larger than the ending price and dividend. So you will only want to take a short position if you expect the ending price to be lower compared with the initial price. That is, you're expecting a decline in the stock price in the future. Okay, now let's solve this example. So let's say you want to do a short sale. In this case, you want to short sell 1,000 shares of Facebook. The current market price is $100. And again, we have the same initial margin requirement of 50% and the maintenance margin requirement of 30%. So the first question is, what is your balance sheet after the short sale? Well, this is actually easy, right? Because we're not calculating margin here. We're just trying to find out what is your asset, what is your liability, what is your account equity, right? So let's see what is your asset. Remember, you're doing a short sale here, right? So if you short sell, you will get some proceeds, you will get some cash. And these proceeds, this cash, will become your asset, right? So to be more specific, you sell 1,000 shares and the market price is 100. So basically, your asset will be $100,000 of proceeds. What is your liability? Well, you have borrowed 1,000 shares of stock to sell. So in this case, 1,000 shares of Facebook is your liability, right? And if the market price is 1,000, your liability is also 100,000. So what is your account equity? Is it zero? It is not, right? Because we're missing something here. So this is your proceeds. However, when you're opening this position to do a short sale, you have to satisfy the initial margin, right? What is the initial margin? It's 50%. So if the value of the stock is $100,000 and if the initial margin requirement is 50, then you need to deposit $50,000 of cash in your account as a collateral, right? To satisfy the initial margin requirement. So in this case, your asset is actually $150,000. So now you can see that your equity is actually $50,000, right? Okay, now let's see the second question. Here, if the stock price falls to $70, how much can you earn? Well, this is actually easy, right? You sold your stock at $100. And if the, okay, let me call this as selling price. So you sold 1,000 Facebook stock at $100. Now, you want to return these 1,000 shares, and you would actually buy from the market, and the market price is 70. So now the purchase price is actually just 70. So you can see that per share profit is $30. So your profit is $30. Of course, this is just per share profit. You have 1,000 shares, so your profit is $30,000, right? Okay, this is one way to solve this problem. We could also think about um, the balance sheet approach, right? And now let's see how could we solve this problem by using the balance sheet. Now, what is your asset? Remember, your asset was the proceeds from short selling 1,000 Facebook shares at $100. And no matter what the current market price is, the proceeds, the cash you got from short selling on day zero stays the same, right? It's always $100,000. And you also have your initial $50,000 of cash, which is added to satisfy your initial margin, and your cash is also there. So the value of your asset stays the same. Now, what is your liability? Well, the liability is the value of your borrowed stocks. You have borrowed 1,000 shares, and now the per share value is 70. So your liability is really 70 times 1,000, which is $70,000, right? Now, what is your equity? Well, your equity is total asset minus your liability, which is 8,000. So how do you calculate your profit? Remember in the beginning, right? In the beginning, your equity was $50,000. And now, the correct answer should be 80,000. And now your equity has increased from $50,000 to $80,000. So in this case, your profit is essentially increase in equity. That is $80,000 minus $50,000, which gives you the same number, which is $30,000. Okay, let's look at the third question. How much can the stock price rise before a margin call, right? So let's assume you will get your margin call at price P. The approach we will use here is it's still about the balance sheet argument, right? So let's see, what is your asset? Well, obviously, your asset stays the same, right? It's $150,000. And what is your liability? Your liability is number of shares times stock price. Again, you have borrowed 1,000 shares. So this becomes your liability. Now, what is your equity? Well, it's 15000 minus 1,000 times stock price. So now, what is your percentage margin, right? Your percentage margin is equity divided by value of stock. So it's 1000p, which is 30%. I don't know what's the answer here. First, you should be able to solve this, right? So to solve this, we will move the denominator to the right-hand side, which gives us 300p. So this becomes 1300p. So p equals 150,000 divided by 130p. Okay, let me see what's the answer here. You can see here it is actually 115.38. Okay, so it's 115.38. So you can see that if the stock price decreases from the initial price of 100 to 70, you will earn $30,000. But if the stock price increases from 100 to 115, you will get a margin call, right? Now let's see the last question. If the stock price increases to $200, how much additional cash you will have to deposit to satisfy the maintenance margin? First, we have learned if the stock price is 115, you will get a margin call. So obviously, if the stock price rises above this 105, rises above this $115, you will get a margin call. So you will basically definitely get a margin call at $200, right? So let's assume you will add C dollars of cash to satisfy the maintenance margin. Remember, the maintenance margin is 30%. So here, let's again use the balance sheet. What is your asset? Well, your asset is $150,000, which stays the same, plus the additional cash, right? And what is your liability? Well, it's number of shares times stock price, which is $200,000. And what is your equity? Well, asset minus liability. So it's minus $50,000 plus C. Now you need your percentage margin to satisfy the 30% maintenance margin. So your percentage margin equals equity divided by stock value, right? Right. This gives you percentage margin. To be more specific, the percentage margin equals to minus $50,000 plus C divided by stock value, which is $200,000, right? Equals to maintenance margin, 30%. So C equals to, so you need to, okay, let me do this one step by one step. So this is essentially minus $50,000 plus C equals oops, I think it's $60,000, right? Well, because basically you're doing, what you're doing is using $200,000 times 30%. So here C equals $10,000, right? So you have to deposit $10,000 to satisfy the maintenance margin. And you can see that this is actually a large amount, right? So short sell is risky. Whenever there is a huge increase in the stock price you're short selling, then you will be in trouble. And this actually often happens for small stocks, right? Because for small firms, their shares are quite volatile. Some news overnight can push a small firm's stock price uh, by like 3 or 4 folds. So in this case, um, you will need to add a lot of additional cash to satisfy the margin requirement. So basically, I would say if you're doing a short sell, you might be want to be careful if you're short selling a small firm, right? Due to the volatility of small firms' equity. Okay, so you can see that you also have these uh, more tidy answers here. Okay, now let's talk about stock valuation. The third part is actually somewhat simple because I think in corporate finance one, you guys have learned um, some basics about this dividend discount model. And dividend discount model is also our major focus in the third part, stock valuation. So I think it is not a hard section. So to do stock valuation, we will basically think about um, 2 sets of models. The first set is dividend discount model and free cash flow models. Both of these 2 types of models are about calculating the present value using some types of cash flows. So in the dividend discount model, the cash flow you're using is dividend. In the free cash flow models, the cash flow you're using is, well, obviously, free cash flow. And this set of models are generally more complicated and they're harder to implement compared with valuation ratios, right? By the way, what is the most famous valuation ratio? I guess it's the PE ratio, right? Stock price divided by earnings per share, right? It's a very widely used valuation ratio. And to calculate valuation ratio, you can see that it's much easier compared with using dividend discount model because you can see that, for example, for this PE ratio, you only need 2 numbers, right? You just get the stock price and you also get the firm's earnings per share, and then you divide the stock price by the earnings per share, you will get this PE ratio. So it's easy. That's why it is widely used. And we will talk about both of these 2 types of models. And we will start from the dividend discount model. Okay, so what's this dividend discount model is about? It basically says the stock price should equal the present value, right? The present value of all expected future dividends into perpetuity. You can see that this is a very familiar uh, type of formula. What you're doing is you essentially discount all future dividends, right? What is D1 here? D1 is the dividend you will get in the next period or on day one, right? D2, you could say this is the dividend you can get on day 2. or year 2. So D3 is the dividend that you can get on day 3 or year 3, right? What is K here? K is essentially a discount factor. Of course, we will talk about what this discount factor is about. So dividend discount model is nothing new. You're again discounting all future dividends using a proper discount factor, right? V0 is essentially the value of the stock at day 0, or the current value of the stock. A fancy name for V0 is intrinsic value, right? So intrinsic value is really the value calculated by the model, by the dividend discount model, right? Um, as I said, what is K? K is a discount factor. How do you get K here? Well, K is also called required rate of return or market capitalization rate. To get K, you could just use CAPM. If you have learned about if you have finished corporate finance 2, then you can see that CAPM is the capital asset pricing model, right? You could use CAPM to calculate the equity cost, right? So here K is the cost of equity. It is also called the required rate of return or market capitalization rate. And if you have some difficulty in understanding this formula, then I would recommend you to possibly to look back into your corporate finance 2 lecture notes or read your corporate finance textbook, right? Basically, the RF here is the risk-free rate, right? This guy is the risk-free rate. Beta, well, it's just the beta. Now, ERM is the expected return of the market, right? And again, RF is the risk-free rate. Now, a simpler model compared with this guy is constant growth model, right? So here we are basically assuming all future dividends will grow at a constant rate of G. So in this case, we can simplify this complicated long formula into a very simple formula. Essentially, it says that if you tell me D1, right, that is the first future dividend, and if you tell me K, that is the market capitalization rate or the cost of equity. And then if you give me growth rate, I could tell you what is the intrinsic value. Right? You can see that this is a simple model because you only need 3 input, right? You get after getting your 3 inputs, you can get your intrinsic value. Okay, oops. Okay, let's see what kind of initial results we can get from the the constant growth dividend discount model. So let's think about this. Let's say if K increases, should V0 increase or decrease? You can see here, K is in the denominator. So if K increases, V0 decreases. Right? What about G? So it means, okay, you can see that if growth rate is higher, then the denominator will become smaller. So stock price will increase. Sorry, the intrinsic value will increase. What about D? If D increases, if the dividend increases, then intrinsic value will be higher. Right? So what does this tell you? It basically tells you that, let's say for this one, it's easy to understand, right? It means that if the firm has a higher growth potential, the firm should be more valuable, right? What about this one? It says, well, if the firm pays more dividends, returns more cash to its investors, then this firm should be more valuable. What about this guy here? What about the first result? It basically says that if the firm's cost of capital is higher, then the firm's value should be smaller, right? Sorry, I should not use the firm's value. The more accurate statement is if the cost of equity is higher, then the value of equity should be smaller. Okay, now let's see a second result. You can see that the second result is the constant growth dividend discount model implies that the stock price is expected to grow at the same rate as dividend. That is, we want to think about P0 and P1, right? So P0 is the current stock price, and P1 is tomorrow's stock price. And then you can see that here we have a simple proof to show you that P1 equals P0, 1 plus G, right? It's actually pretty easy to understand because you can see that this is obvious, right? And D2 obviously equals D1 times 1 plus G, which is, here G is the growth rate. And we know that we have a constant growth rate, right? So this step is obvious. And then one thing here is you can see that D1 divided by K minus G exactly gives you P0, right? So this one is pretty easy to understand, and you can see that the stock price will increase at the constant growth rate. Okay, let's see the example, and then we can finish today's class. A stock will pay you a dividend of $2 per share at the end of the year. The dividend will be fixed in the future, and the discount rate is 8%, and the market price is $30. Is the stock undervalued or overvalued? First, what's the general approach of doing this, judging whether the stock is undervalued or overvalued? Well, you want to compare the intrinsic value versus the market price. So if the intrinsic value is larger than the market price, then this stock is undervalued. If the intrinsic value is smaller than the market price, then this stock is overvalued. So basically, to make the judgment about undervaluation or overvaluation, the first step is to calculate the intrinsic value. So let's see. So we have a dividend of 2, which will happen at the end of the year. This implies D1 equals 2. The dividend will be fixed in the future, which implies G is 0, right? Because dividend is fixed, there is no growth. And discount rate is 8%. Okay, great. We have all our 3 inputs here. So we could calculate the intrinsic value, which is D1 divided by K minus G, which is 2 divided by 8%. Let me see. I guess it's $25. So this is the intrinsic value. It's smaller compared with $30 of the market price, which means this stock is overvalued, right? Okay. Now let's see the case with a different growth rate. So previously we had a growth rate of 0. Now we're having a 3% growth rate. And obviously we still have the same number of D1, which is 2, K is 8%, right? So now we have a different growth rate, which is 3%. Now let's calculate the intrinsic value. It's D1 divided by K minus G. So it's 2 divided by 8% minus 3%. So it's 2 divided by 5%. So this is 40, which is larger than the market price of 30. So in this case, it is undervalued. So let's pause to appreciate these two different questions and see what kind of lessons we can learn here. You can see that when you're comparing these two problems, the only difference is the growth rate, right? So if growth rate is 0, then you will get this result, overvaluation, right? The stock is overvalued. But if the growth rate is 3%, the stock will become a undervalued stock. It will become a good buy, right? So you want to make the purchase. This tells you that the dividend discount model is very sensitive to your input, right? Changing from 0% to 3% is just a small change, right? But this very small change in growth rate will generate large differences in the intrinsic value. It's 25 versus 40, right? It's a huge difference. So you can see that whenever you're trying to use the dividend discount model to value a stock, it's very important to check the robustness of your estimate on this growth rate, right? Okay, now let's see two more complicated problems. So it says, if the discrepancy before the intrinsic value and the market price will never disappear, what is your return if you hold the stock for 1 year? Now, what is the intrinsic value? This guy here, 40, right? This is the intrinsic value. And what is the market price? Well, this guy here, market price. As an investor, if you think the stock is undervalued, you will want the market price to converge to this intrinsic value, right? Just imagine this. If you make the purchase at a price of 30, and after your purchase, the market price converges to its intrinsic value, you will earn $10 per share, right? So you will want the convergence to happen. So now let's assume you're unlucky. The intrinsic value will, the market price will not converge to this intrinsic value. That is, the difference between the intrinsic value and the market price will never disappear. So in this case, what is your return if you hold the stock for 1 year? Remember that for 1 year return equals the stock price at the end of the year plus the dividend at the end of the year divided by initial price. So we have the initial price, $30. This is the market price, right? What is D1 here? D1 equals 2, right? Now, what is P1? Well, to calculate P1, you have to use the fact that the market price will not converge to intrinsic value, right? In this case, it implies that P1 equals P0 times 1 plus the growth rate, right? How do you get this? Well, we just learned about this, right? P1 equals P0 times 1 plus G, which is the growth rate. So this implies we will use $30, 1 plus 3% plus 2 divided by 30. Oh, I forget to, we have to, to calculate return, we have to minus 1, right? So minus 1. So this gives us 3% plus So this gives us 3% plus 7%, which is 9.7%. So how do you get a 6.67%? Well, it's just 2 times 30, right? So it's just 2 times 30. Okay, now let's see the last question. If the discrepancy between the intrinsic value and the market price will disappear by the end of the year, what is your return? Right? Now you can see that the formula is essentially the same. Right? It is the same. And you will give 30, and you will also get 2. Now, how do you get P1? Should you use P0 times 1 plus G? Well, you should not use P0 because you can see that P0 equals $30, right? However, this is the market price. But now we have said the intrinsic value and the market price will actually converge, right? So here you should not use P0. You should use V0. You should use the intrinsic value, right? That's the major difference here. Again, you can see that here you're using P0 to calculate P1. Here you're using V0 to calculate V1. Why? Well, because in the first case, the market price will not converge to the intrinsic value. So you should use P0. The second case, the market price will converge to intrinsic value. So you should use the initial intrinsic value to calculate P1 here. So here in this case, we have 40 times 1 plus 3% plus 2 divided by 30 minus 1. And I think the answer is 44%, right? So it is 44%. So you can see that whenever you're doing this stock valuation, if you find a undervalued firm, in this case, if you make the purchase, it's very important to see that or to understand your holding period return, your return will depend on whether the market price will converge into the intrinsic value, right? So in the case of no convergence, right, the return is relatively small. And if the market price catches up to the intrinsic value, then you will be the lucky investor to get this very high return of 44%. Okay, that's for today's class.